And good morning, everybody, and good afternoon, actually, if you're on the East Coast. My name is Michael Filighera. I am with LogicalSignals.com and also TradeOutLoud and I'm going to give my presentation today on how I use Elliott wave, Fibonacci, and moving averages in my day trading. And what I want to do is I'm actually going to be using two different charts providers. First one being Thinkorswim platform, which you can see right now. And then I also use a NinjaTrader to actually trade. So I will go over to that in a moment. I don't know how many are actually familiar with Elliott wave and the Elliott wave theory. And so I'm just going to give a quick background on that because I find it to be extremely helpful and engaging where a market's going, what a market's doing, and it's usable and trackable from a 1-minute chart to a maximum monthly chart. And I will show you how that all works. I'm first going to go to my monthly here. And now you're going to see, again, all the numbers. And that's, I am tracking the finishing moves on a primary level third wave. And that's within a much larger advance, which is going to be completing a cycle level 5. And so what Elliott wave really is, it's a measurement on how we can measure what a market is doing. And there are two basic forms. One is an impulse sequence, and those are going to always be a 5-wave sequence. And then there is a corrective sequence, which is always going to be a 3-wave, an ABC. And so they're labeled as that, wave 1, 2, 3, 4, and 5. Within an impulse move, and that could be in either direction, it could be up or down, you have that basic wave 1 up, wave 2 down, wave 3 up, and wave 4 down. And those are the impulse. So wave 2 corrects 1, wave 4 corrects 3, and then 5 completes that sequence. Once that is complete, you should then be expecting and looking for an ABC level correction. Now, what that really portends is depending on where you are in terms of these building blocks. So if I go back to my other ones, you're going to see that I get the same type of moves. And this is a 1-minute chart. There's a 2-minute chart against the hourly chart here at the end. And you'll see that each one basically produces the same, like right now, we're just looking for a corrective move up, and we're getting that. And it is following through in terms of being basically just a 3-wave, but it's going to turn into a 5, but it's still going to be corrective. So what I'm basically saying is how I put this all together is that I, at the end of the day, review the markets. And I always start on my hourly chart. And because that's going to be the nearest term or the shortest term that I'm actually going to be able to trade off on a daily basis, unless we're really moving into a much larger decline or rally, which then starts to reflect upon the indicators and the moving averages and the Fibonacci resistance and support levels off of a daily chart or off of a weekly chart, depending on the size of that move. So right now, what I'm counting here in the NASDAQ, which is what we have up here, is I'm counting a minor wave 5 advance. Now within that minor wave 5, there are going to be 5 waves of minute degree. Okay, so by moving up the ladder, the minor wave 5, once it's complete, it's also going to be completing an intermediate wave 5. If I go out on the daily, I should be able to, nope, it's going to take me to go out into the weekly. So you can see there's the 3, intermediate 4, we're in intermediate wave 5. So now I'm going to slip back out to that monthly chart that I just had up. And you're going to see that here's 1, and these are intermediate level, 1, 2, 3, 4. And once that 5 is in, it's going to be completing a primary third wave. Now, let's just look at how much time has been involved in putting in top, or the completion point for a primary third wave. This primary third wave began in November of 2008. So this rally is pretty long term. And right now, we're buffeting up against being 2 3/4 to 3 years, 12 3/4 to 13 years in length. And so that's going to give you an indication of what's coming next. It's going to start up at this level. We're going to have a primary fourth wave corrective phase. That phase, if this rally took 13 years to unfold and complete, we should really, even on a Fibonacci basis, probably be looking at about a 2 to 2.5 year window where this next corrective phase is going to unfold. So that's the outside of, but a very big picture. Now, having said that, we're going to get a primary fourth wave. It's also going to have to include an intermediate degree decline. And let me go back to that other chart. So if I come down to even to the daily chart, if I can, let's go to the weekly. So you can still see that it gets all crunched up because of, I've got a bunch of stuff all labeled on there. So it's difficult to see these levels until I start to bring it down to where we can see. So we have 4. And now within that, I have wave 1, wave 2, and this is wave 3 that we're working on getting up and completing. Now let me go back down to that hourly chart. Again, here's that wave 2. These are small waves. And one thing I want to add is that 5 wave sequences, the wave 1, 3, and 5 will be 5 waves of their own. And then the corrective waves actually are going to be harder to trade. And here's why. Because corrective patterns, at last count that I had, come in 13 different variations. And so we always have to allow the market to tell us what variation they're going to go through. We've got to give room all the way up and down for extensions like we just saw. Not common, but still very acceptable. This particular wave 2 correction ended up being what we label as a triple ABC pattern down. And there was the first ABC, and they're always separated by X waves. And there was the X wave, which is also a 3-wave structure. And we had another ABC, another X wave, and then a third ABC. And that completed it. And then we started to blast into the upper levels, which is what I was looking for. Now, within this next third wave up, which normally within a 5-wave sequence, the third is going to be the longest and the strongest. So we have just basically finished what I'm labeling as the first wave up. So it's going to be a small, minute, a sub-minute wave 1 within this minute wave 5, within this larger, minute wave 3, which in this larger minor wave 5. Now, I know this all sounds very confusing, but once you get into the gist of how these are all building blocks, you will build an additional habit of not counting too fast. So in other words, not putting marks on the chart because, oh, that's 5, that's 1, and then you're really counting too fast. So your degree of what you're counting will approach that you're finishing something that is on a much smaller level. And so you're not going to get the moves that you think you're going to get. Enough said there. So right now, this is where I start. And I do a daily video cast. And so on yesterday afternoon's webcast, I had been talking about how off of this, I put this as a completion for a very small third wave. And then this was the fourth wave correction. It did hold support. And then the market started to move higher. Difficult at first, but eventually we did break. And I was looking for a move and a close above 13,800. I got that. But then I thought that the market still needed one more additional high and get closer up to 13,900 before, again, it pulled back. And I originally called 13,884 as a level that I thought it could get to and then drop back down. In any case, we got above 13,900, which is a strong supportive area for this larger rally to continue and to eventually reach new highs. So, but once it got there, I had said, we will get there and then we'll be looking for a wave 2 correction. So if this is only wave 1, then we got a wave 2, and then we're going to have an additional stronger rally. That's my take. Now we're going to see what the market wants to tell us, because what I also include in everything that I do is we always, always, always allow the market to tell us instead of me trying to tell the market. It's never going to work that way. So I allow the market to tell me what's going on and where it wants to go. So we got up there, we immediately dropped over 100 points off of that level. And again, we're still over 100 points off that level. In fact, it dropped 160, and that is not uncommon for the NASDAQ. It'll reach a high and then boom. Because all the way up, you could feel that there was sell pressure sitting around. And then it just came in today again, because we broke again above a major level, which is 13,900. So what am I going to look for? Well, I'm going to start to pull this down so that we can see that I'm looking for, I'm going to go down to the 15-minute chart. I'm going to be looking for an A, which this appears very strong to be, because it, first of all, it came down into support for this larger move. So, sorry, let me back up because I already had this on there what I'm explaining to you. So once I got my Elliott wave count down, I start to wrap Fibonacci sequences around it. And there are two types. I can just do Fibonacci retracements, which are basically just going to tell me where the levels are going to be for a retracement off of this particular rally. That's what I'm looking for, since I believe this finished a wave 1. Now I'm looking for a wave 2 correction. So now it starts to come off. Your minimum level would have been 0.236. Another most common level is 0.382. And then you have, for wave 2, the most common, which is 50% of that first wave. And that's going to be at 13,690. And we have an outlier here in case it pushes even harder, and that's 13,637. So you can build zones around that as the move would progress. Okay, so intraday now, I've gotten my first move, or what I believe is the first move down, and now we're starting to rally off of that point. And what I would now look for, this would be wave A, then I'm going to get a B wave bounce back up, and I'm looking for that right in here. Now for B, most common is 0.382, and that's 13,850. So that's quite a bit. We got another 60 points, so we rally back up to here. And will that happen today? Possibly. If not, then you're going to be looking at that this move likely will extend out to tomorrow as well. So you can get some time factors down. You can get levels of where you're going to trade from. Now, how do I now translate all of that and put it onto my trading charts? So let's go over here and put those three charts back up. So I now, for my trading, I work off of a 1 minute, a 2 minute, and a 5 minute chart. And so because I'm talking, folks, you hope bear with me and just allow me to go down to a sim account so that I can trade and show you, and also just continue to talk. Because I would not recommend talking and trying to give a webinar and trade in a live account, basically because just distractions can happen and we need to react when we're day trading. Excuse me. So now I'm down here. Now, another layer that I add particularly during the day is I use moving averages. And the moving averages that I use are a 4 minute, and 8, or a 4 day, an 8 day, a 20 day, a 50 day, and a 200 day. And those function beautifully all the way down to the 1 minute chart. And how I use them is right now, because I feel we're still moving up, here's the 4, here's the 8, here's the 20, here's the 50, and the 200 still sits above. So my first guess here would be that if this all holds and it bounces, which it appears to be doing, I would then look to take a long position if it were to continue to hold above this 8. And that should signify that we're likely going to move up and try to get up to that level, up to the 200-day moving average on the 1-minute chart, which is at 13,815. And here you can see it's holding above the 50, then the 4 and an 8. So our moving averages across all the charts are not in sync. Now, I'm going to show you or tell you about something that is very, very valuable in terms of using when you're trading. And the moving averages at times, and this morning might have been a better example of that. Yeah, as we were moving up here, you're going to see that all of the moving averages on the 5-minute chart were in sync. Here's the 200, here's the 50, here's the 20, here's the 8, and here's the 4. All above. So the 4 is above the 8, the 8's above the 20 is above the 50, and the 50 is above the 200. That's in alignment to go up, and that was the 5-minute chart. It was the same on the 2-minute, and was the same on the 1-minute. And they switched dramatically once the 5-minute came down and broke below its 4-minute. But here on this 2-minute chart, it had already done that, and the 1-minute chart had already done that. So that threw out an immediate signal to the possibility that the markets were turning and the markets were now going to go down. And keeping in mind, that's kind of what I'm looking for, because it had gone up, it had reached an upper level that I thought this initial first wave could do, and was turning, which is exactly what I was looking for in terms of that's finished, now we're moving into a wave 2. So why am I laying this out like this? Because this is how you're now going to figure your next trade. All right, so if you're here this morning, you started to see that your moving averages were being broken. First the 4, then the 8, then the 20, and of course then the 50. And eventually it came down and it broke the 200. And that just then put all of the moving averages in line to go down. And so now we've determined that. Now we need to kind of start to put together a little bit larger picture of what can we get to. So now let me just tell you about what these other lines on the chart represent. Right here at 13,861, 862, that is the value area high. I'm sure if you've been in a room or you've done some study, most people are familiar with a value area high. This next one down, which is kind of in a golden color, is the point of control. And then right below the point of control, we have VWAP, the value weighted average price. So VWAP sits right there. Then coming all the way down at 65.75 on my 1-minute, a little bit higher on my 2-minute, and a little bit lower on my 5-minute chart is the value area low. And these are important because when a market is rallying up, like here, it's breaking above some levels. And so the thought process behind it is that the market is likely going to reach the 5-minute 50 or the 2-minute 200, or possibly back up to VWAP. But on the way back up, these 3 levels, the value, the 200-day moving average, VWAP, and then point of control, are going to provide resistance. And that's the point of control will always provide some resistance and or support. And the point of control is that's the point where buyers and sellers are okay coming in and doing business. Above, below, but they're going to hang out right there. And that's perfect for a lot of people because they can base their trades on that, around that price, and get their work done. For whatever reason they need to come in and do, it's nice that they can do it right there because that's where the market's going to stick for a while. If the market does not continue to move higher, but is held by these levels and then turns lower, then you're opening up the door that it's going to drop back down and at least start to get back down to our other moving averages. And that's the ebb and flow of the market. If the market were to break above 832.25 and get a good close above that, well, then our next level is going to be value area high. And if it's going to break there, then we have upper bands that are showing us where we could go. And we will also determine some additional levels for on the way up. Lastly, what I add is I keep a stochastic monitor here, which A, can show me divergence in the market, and B, is going to show me when one is kind of getting a little stretched thin and it's moving into an overbought or oversold. Now, I don't recommend holding on to a trade in that level because there are many, many times when a market can reach overbought or oversold, and just keep doing what it's doing. So they're just an indicator, not a market god type of an indicator. So they're just giving you what's going on behind all of this. But if the buying is already pretty intense and we're blasting higher, well, then being overbought is kind of a given. We can determine that we're looking for a pullback, but if a trend has been established in that direction, pullbacks might be shallow. So now you can see how I now adopt these into the larger picture of day trading. So let's kind of just now go in what we're looking for in individual moves. I always do look and balance against my 60-minute chart, and I probably can get that right there, although I can get the 15-minute, and that's also very good. Here you can see that we kind of got a little bit of a turn, and that's reflective. We've had the buyers now coming back in for about an hour, but we've now moved into a period where it's pretty slow. We're into lunchtime, so it's slow. And that's not a bad idea because now we can just basically look. But see how this is now moving lower and it's holding. Now, yes, we have breaking down below. Now let's see if I can get a rally back up. And we're going to just try a trade. Okay. So why did I do that? Because it kind of went down and broke and then came back up, and it's now testing that. Okay, so what do I do when I enter a trade? Well, first, I want to just think what I can make on this. I'm looking for a possible move down to the 1 minute 50, which sits at 97.92. That's my target. So I've established my target. This is just a day trade, and we're going to see. But if I'm only willing to really collect $100, I cannot risk more than $100. So I would always put my stop up here at 275. We'll put it at 250 because that should, oh, we don't want to sell it. Sorry, I put the wrong one. Buy stop. We'll put a buy stop there. But now we're moving down, and I need to put I did that because I didn't want to miss it. So now you can see how that trade came through, but now see it is pushing through. And so there's two ways to attempt that. We got out at the target because that's what I was looking for. Now we get a chance to see what's happening. Will the market just come back to that 50 moving average, 50-day moving average? But boom, the next bar showed us that it's continuing to find buyers coming into the market. That fits against a very quick 1 minute stochastic, which showed it down. But now I want to make sure that it can get above these two moving averages before I will look to buy it. And we're now just kind of hanging out and waiting. But you can definitely see how that comes into play and can be very profitable. Again, when you're trading, you need to bear in mind, this is the NASDAQ Mini. It's $5 a tick. There are 4 ticks to $1. So when it moves $5, it's $100. And you just saw how easily it moved $5. In fact, it was $5 plus. And then boom, go right back. The NASDAQ can move dollars in a blink of an eye. So part of determining what you're going to trade and how you're going to trade is going to be very important, because the S&P on the mini contract is $12.50 a tick. And again, $50 a point, $1. It takes the S&P a little bit longer to move those dollars. Okay. I will get to questions in 1 second. The S&P does take a little bit longer to move dollars, but with the volatility in the markets being what they were, here where you can see 1 5-minute bar took it from, let's say, 42.13 up to 42.21 in 5 minutes. That's a pretty strong move. So you must put your trades together with the following in mind. What is your objective? What are you looking to make? What are you looking to risk? Where is your entry? Where is your exit? And where is your stop? Those things must be established, because the last thing you need to do is to be caught in a trade and then say, oh, I'm not going to get out. I think it goes my way. Dangerous, dangerous, dangerous type of a way to think, particularly in volatile markets, which the NASDAQ and the S&P have been, excuse me, recently. Okay, I want to answer a quick question. Michael, you asked what charting package is this with the Elliott waves. It isn't a charting package. Those are mine. I actually physically go in and label a chart on this Thinkorswim platform. And Steve, the NQ moves very, very fast. Yes, it does. And so that's another factor that one has to consider when choosing which markets you want to trade. I love the volatility in the NASDAQ. It can be very kind in terms of you're on the right side, but it can be a monster when you're on the wrong side of a trade and you're not covering that trade. And this is where I want to make a very, very, very strong point. You cannot hold on to a bad losing trade, because it'll go from being down $250 to being down $1,000 in a heartbeat. And I kid you not, the NASDAQ will just move. And it did this twice. I mean, it's done it more than twice today, but let's just take a look here on this 2-minute chart. With this move, it kind of, oh, we're going to go up, and then it backs off, and then it just starts to sell. So let's just say you were long from here. I'm just going to pick a point. 38.16, you were looking for it to get up to the point of control. Fair, nice trade. And these were at the time pointing higher. But you got long, I'm even going to go higher. You got long here at, again, 1650. Where was your stop? And maybe you didn't put a stop in because you were thinking it's going up here. So it's here. You decide to pick up another one here. And now you're long 2 contracts. That's at 05. So you're already down $11. But your 05's pulled it up a little bit. And then suddenly it drops again to 91. Now you're down $16 more on a 2 lot, $10 times 16. I'll just tell you, 16 times 4 times 2. You're down a lot of money already. And that's how fast it can go. And then it just got worse, and then it got worse. So once things really start to get bad, many people just drop into this thing. Oh, it's got to turn around. It's going to turn around. It's going to turn around. Maybe you add another contract. So because you don't want to get out and take the loss, prevents you from doing so. And now you're missing the move, because this actually was a very, very profitable drop. So you're going to sit in a trade and let it go against you, and then not want to get out, because as soon as you do, it'll go turn around. And maybe you hold down even more and you've added in. But now your account is going to get closed because you've lost too much money. And when that can happen, now you're just basically giving up on everything you just learned, because it didn't work for you. So the third or fourth component that I add into how we become successful day traders is the mindset. And the mindset can be very, very strong. And most people, we've been through this. We tend to make the same mistakes over and over again instead of learning from our mistakes. And then, so we really need to identify that reason why. And I have got some methodologies and kind of narrowing it down to what bad habit do I need to change in order to maintain a healthy P&L. And so I work things out myself, but I also can then use a coach to kind of bounce things off of and help me identify where that weakness in myself lies. And for me personally, and I'll share with you, that weakness comes out in me usually when I am wrong and I won't get out of the trade. Then my greater mind, my smarter self, knows not a good idea. You need to reverse the trade. You need to not sit out this decline. You need to play it. And the only way you can do that is taking your loss, reversing, and catching the next legs down. That is the result of not making the right decision. You fail to make the money that, say, for example, you were long there, but you flipped it because you could see that it's going to continue to break below your moving averages, and now they're all pointing down. Well, then you reverse. You get onto the sell side. So maybe you just get out, take your hit, you watch for a minute. Now you've got a clearer picture of what the market's trying to do. So you get in on the short side, and now you're running it and making all your money back, then some. So that's my point. My point is, don't let the market shake you so badly that you don't get out. Don't let fear step in, which is a big statement, I'll tell you that. Don't let fear step in or doubt step in of your own ability. So again, it's returning to the mindset. It's returning to what happens to us when we allow that mindset to take over and rule. When it's in control, then you're missing moves. You're missing everything because now you've got this fighting force going on between your ears and in your mind telling you, wow, you're losing all this money. Wow. How are you going to make this back? Wow. So you get out. Now you're down, let's say 750 or $1,000. Very easy to do in the NASDAQ. So you're down that kind of money. Oh my God, how am I going to make this back? Oh, that's too much. Now you're compounding then on your own negative situation. Instead of being able to take the loss, get back up, get back in the market, make the loss back and keep trading. Because I'm going to tell you, that was a very tradable move. These were tradable up and down. So it's actually, you're a day trader. So knowing when you're going to hold on to a trade, when it's a scalp. And so you learn how to play both. That was very tradable. That was tradable. This was extremely tradable. So as I was trading this morning, I was looking at this going like, oh, okay, what we have is an A, B, C. So I had limitations. When it starts to break above those limitations, which it did eventually here, just as we came on, that tells you, okay, it's something different. So whatever position I may have had on, if it was a long, great, I'm going to let it run. But if it's a short, I'm out. I'm out. I'm taking it. I'm getting out of it and then going to take a review. So again, you can see we went back in and just with a clear mind said, okay, we're looking for this. We got it. Now we're getting that. These are all important factors. But if you don't have the correct mindset and you're still rolling around, calling yourself stupid, getting upset with yourself because you've just walked yourself into $1,000 loss, it's going to become really hard to trade out of it. So it's vitally important that when these things happen, you are able to clear the board and get restarted. And one way to not have to clear the board is to honor your stops, to pay attention to your moving averages, pay attention to the Elliott that you're using, to the Fibonacci levels that you're using, and work your way out of that problem. Now, again, going back to what we're doing right now, this 15-minute chart is basically, I'm not sure why. Oh, because I'm just looking for a small rally, right? I was looking for a smaller rally up, which we're still in progress of. So we've just basically hit the bare bones minimum of where this thing should go. And now we're kind of looking for these upper levels, like I said before, to give us that wave 2 bounce. But let's not forget wave 2. It's an ABC structure. A up, B down, C up. So we still have to deal with that. Then you've got to come back and you've got to look at your structures as they're happening. A waves can come in a 3-wave form, or they can come in a 5-wave form. This one looks like it's actually kind of coming in an ABC up in and of itself. And that would not be good for the downside. I have to tell you, if this completes this thing up here closer to this point of control. But let the market tell us. Let me just take a quick peek and see if I can get to this one. Nope, that's the panelists. I don't need index, new share, portion. Where are you? Where's the chat box? Give me 1 second because I'm working off of 2 screens and I can't find the chat. All right, never mind. David, if you get a chance, can you open that chat box for me? And I just want to keep up on questions. So,
I can't open it for you. You have to move your cursor to, I think it's usually at the top of the screen where the zoom menu comes up. And
right, I see that.
There's a more button.
I got it, found it.
And there should be a chat that should bring up the chat.
Yep, got it. Thank you so much.
Yep, no problem.
In any case, so I'm going to keep this over here, guys, so I can see it when we need to. Good. Okay, so because we're kind of slow, these are periods where it's good to talk. It's good to ask questions, because what I'm just going to do is continue to talk about Elliott wave, continue to talk about Fibonacci, continue to talk about how I'm using them. So if you have a question, please put it in that chat box and we can get to it. So we're now kind of going to determine, okay, we're looking for our next trade. And bearing in mind that I have Fibonacci resistance at 13,834, and that's on my 15-minute chart. Ultimately, I'm thinking we're going to get up to 13,850, which would be the 0.382. Now, once you really start to master or just understand Fibonacci and then Elliott, and then how the two are combined, it goes pretty much as follows. There are characteristics for each type of wave. There are characteristics to a wave 1, to a 3rd wave, to a 5th wave. There are characteristics for a wave 2 and a wave 4. Those, when you see them occurring in the market as you're trading, it just gives support to what you're counting, what you're putting together as your picture. Now, Elliott wave comes in building blocks. So the same patterns are going to be evident and clear on a 1-minute chart, on a 2-minute chart, on a 5-minute chart, on a 15, on a 30, and an hourly, etc. What they are is the 1 minute is building to the 2 minute, the 2 minutes building on the 5 minute, the 5 minute, etc., etc. So you can see why I always will start with what I would use as my largest daily view would be the hourly chart. So that's where I'm going to start. And that's where I put all of my labeling. And that's where I also run Fibonacci's on that hourly basis. Intraday, I can run Fibonacci's on, actually, I would probably run it on the 2. Let's just do this for the sake of teaching. I'm going to put Fibonacci retracements, because if this did complete this move, I now want to give it some parameters in case it is now going to start to go down. So we've now put that in so you can see. If I'm going to look for a pullback from here and it still has upside, well, it looks like it still has upside right now. And we can always revise those numbers. But let's just say, for the sake of our discussion, that was kind of the top. You're not getting that sell signal yet, because on a 2-minute, it really needs to break below this 8 and actually close, get below it, and then bounce back up to it without going over. But let's say it has. So now we're looking for a lower move. Well, in any type of a pullback, 0.382 is going to be pretty common, and that's 13,786. So you can see from here, well, that's a pretty good size move. We can make some money if that were to be in action. The more common is going to be 50%. That's 778, even better. So you can start to look, and then we have the value area low sitting just above 0.618. 0.618 would be your bottom line. It starts to break below 618, then we're heading lower. So you can see that you start to put together your picture, and you can do it intraday. And that's basically how I put together my trades. Now, when we're trading in the morning, which is your opportune moment to make the bigger money, because here you're going to sit and wait, you can see the market's not really jumping around all that much. We've moved into a very typical slow period, which is during that lunch hour on the Eastern Coast. So I tend to not trade right now because it's just waffling around, and you're going to get signals that it's doing that. Again, look at our moving averages. Very, very slightly on the 1 minute, very slightly pointing up. Here, the 50's kind of going sideways. And if I had to move out to my 15-minute, where are my moving averages on my 15-minute? I guess they're not there. Let's go out to the hourly. For some reason, my moving averages aren't on these charts. Okay. I don't have time to set that up right now, but we're going to go back over here, and I'm just going to put them on that chart. Let me put all of them back up. Ding. Ding. Okay. So I'm going to put the hourly chart over here. And I'm going to be able to take a look. Come on. Thank you. So on the hourly chart, we still have more room to slide lower before we really start to rally with any strength. And understand that for moving averages and your stochastic, your other momentum indicators, it's going to take a while. This is a 60-minute chart. That's the biggest boat that we're trading off of. So it's a big boat. It takes a lot longer to turn it. And you can see here that it looks like it is heading up to its, that's going to be the 20. The 20-day moving average is at 38.15, and it got up to just right, almost to that level. And that can be very significant in terms of how they want to trade. Because you can see it did. It got straight up to that hourly 20 and turned away. Now, why would it turn away? Let me say that many of the algorithms that are being set up to put through buy and sell orders trigger off of the moving averages. So, and how does that work in our favor? If we have, like I described before, a situation where all of our moving averages are all angling in the same direction and are in alignment in that the 200's on the bottom, the 50's above the 200, the 20's above the 50, the 8 is above the 20, and the 4 is above the 8. That's alignment. And when they get in alignment, do not fight the move. The moving averages are telling you that the market is going in the direction of this trend. Now, that works on both directions. So whether that market is pointing with all in alignment to go up or all in alignment to go down, The point that I'm making here is you don't ignore that. If you do, you do it at your own peril, because the market is already telling you this is the direction we're going in for the next 5 minutes, the next 10 minutes, the next 20 minutes, the next hour. That's what it's telling you. And how do we determine, okay, what do we do to signify that it's turning? Well, as I said before, that how we determine that is when these moving averages start to break. We saw it here, and that was a pretty big bar. And it came down and it broke the 4 and it broke the 8. And then I imagine if it did start to go back up, you could see that the 4 was hooking and then the 8 was hooking. And then see here, it started to rally. But this told you they're hooking lower. So, and once it touched that, you could see that that was the signal point for the next round of selling. And then boom, and then boom. And probably each time it passed through, it triggered the next sell program to hit the floor and the next sell program to hit the floor. Same thing when we started to go up. Here we broke the 4. If you're day trading, you were looking like, well, we broke the 4 again. I'm going to buy it because I think we're going to get up to that 2-minute 8. Well, it did. And I'm going to tell you, let's just say you bought it there when it broke above at 30, let's call it 39. And then your trigger, you targeted 45. That's $6. That's $125. Take it. Why not? It's good money. And here maybe you got out and you saw that it came down again, and that would be okay. But then it started to go up, and when it broke, now you knew, okay, we're going to head towards VWAP and the 200, and it did. Steve, yes, it did. It did go all the way down to the previous state point of control. You're absolutely right. Very good observation. Steve follows these things, guys. That's a good one. The market does tend to go to these levels. People say, well, why? It's like, because that's what it does. Because there are enough algorithms, there are enough computers that are geared towards following those. And they end up producing their own moves simply because of what the market actually does. So why do we want to fight it? I'd rather go along with it. It's much easier. Yes, they are. Steve again mentioning point of controls are major magnets. Yes, they are. Absolutely correct. They are major magnets. So I realize that I have to tell you folks, 55 minutes goes real fast on these webinars, and I never get to really get into the depth that I want to, but that's okay, because my point here today was to bring this to people, to bring it to you guys so that you could take a look, so that you could hear, so that hopefully I only got one trade because that wasn't busy enough, but you can see how we use it during the day. And the reason I'm now adding this is because I also want to add in that I do a video podcast each day for the NASDAQ and the S&P, and soon I'm going to be adding gold. But right now I'm just sticking to those two. And that I give the setups and I give what to look for the next day. I give an upside Fibonacci and I give a downside Fibonacci. So I keep us covered. And again, stress again, allow the market to tell you where it's going and what its intents are. And then the second thing, always trade using your moving averages all day long. Every second you're in the market, keep an eye on your moving averages. They will guide you and tell you what is happening and how strong it's going to be. The moving averages do fail every once in a while, but if you're using them correctly, your stops and your exit points are all wrapped right around them. So you're never really putting yourself out there for major risk. The other thing that needs to truly be accepted if you're going to come in and you're going to attempt to day trade is the fact that you cannot hold on to a trade that's going against you. As a day trader, that is like walking into a death spiral. It'll ruin your P&L. It'll take down your account. If you're attempting to get funding through the various companies that offer, and I put quotes around it, combines, so you can go in and prove that you know what you're doing, then you're going to blow out more combines than you care to talk about. And folks, this, I'm going to be honest with you, I've been trading for over 40 years. And no, every day is not an up day. Absolutely not. But you can limit the loss. Definitely limit a loss. But it takes strong discipline. It takes being able to push negative away from you so that your focus remains where it needs to be. We all could have the best tools on the planet, and we've developed them and we've studied them and we know how they function. And then you fail to listen to what they say. That is a major stumbling block. That is a mindset issue. So again, I want to just quickly review. I use Elliott wave. I use Fibonacci sequences. I use the moving averages, but not number 4 on the list. By any means, it can be number 1 on the list. I check in with myself each and every morning. And that's what I do, what I call an SET score. I give myself a scoring because I take a look at my sensations, my emotions, and my thoughts. And if you don't do those 3 things and do it honestly, then you're walking yourself into some trouble, because your mindset is already going to be working against you. And I'm talking about, your sensations or your emotions. Let's talk about emotions. You're coming in, you're a little bit fearful because of how you want to trade today. Maybe you had a fight with the spouse that morning or the night before, and you're still kind of brewing over that. Blah, 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 blah. That is going to have an effect on how you think and how you react. The rest of your emotions or your sensations, I got a headache this morning. My head hurts. My joints hurt. I got a little bit of an upset stomach. What's going on down there? Blah, blah, blah. Those are going to affect how you think, feel, and react. So if we make ourselves aware of these things ahead of time, boy, you're giving yourself a big helping hand, because you always get to have a decision point. Do I trade? Do I not trade? So if your decision is to trade, you're doing it with the understanding of how you feel, how you are thinking, and how your emotions are. So you're giving yourself a head start. If you can block those out and get into tune with the market, that's going to involve in picking your point where you're going to enter. What is your goal in terms of what are you looking to make on that trade? So you're going to put your exit level almost there, and you're going to put a stop in. You're going to use good risk management. You must honor a stop. Even if you're saying, well, I always put my mental stop in, well, good. I'm glad that you're strong enough to do that. Honor it. If you don't, you're walking yourself into trouble. Now, no matter how many times you say, well, I've seen the market do this before, and it goes down, or it goes up, and then it turns. Right when I decide that I'm going to get out and take my loss, it turns and comes right into position. That may continue to happen, folks. But here's where you get to make another choice. You get out of that trade because it's not a good trade, and that's what your focus is on, what you're now losing. So you've stopped that process. Now you've cleared your mind to go back in and look, and your next trade might be to go in and do the exact same thing. Yes, Luis, very good point. It's really hard not to revenge trade when your first trade is in the red. But as Luis says, he always reminds himself to stick to the plan. Absolutely. Thank you, Luis, because that is a very, very, very good point. It's really hard not to revenge trade, folks, because you've allowed anger in. So it's another emotion. Revenge trading is nothing but anger, saying, you stupid market, I'll get you, I know what I'm doing, et cetera, et cetera. Best to close that trade, clear your mind, and go back with a clean slate. The market is not picking on us as individuals. It could care less. There are too many people trading. They're not going to us personally. Who's fighting us? We are. We do it to ourselves. And that's the voice of experience. I've had a lot of success in the market, tremendous amounts of success in the market, but I still make stupid mistakes. And I still am very critical about those mistakes that I make. But I'd rather admit that I'm not perfect in order to be able to be in a position to, number one, help myself, and number two, help anybody else. Okay. Thank you very much for this time. David, I'm going to wrap up here. Please go to YouTube and Traders Helping Traders or logicalsignals.com and subscribe to my YouTube channel. That way you are going to know when I put on a new video cast. And also the above, I'm going to be starting a trade room. I've had trade rooms in the past, and I've gotten a lot of inquiries from people that have followed my video casts and also know me. And they keep asking, when are you going to start another trade room? Well, that decision has been made. I'm going to be starting a trade room beginning on June the 21st. I intend to put out a major email describing all of that with the pricing, with my promo pricing, and all kinds of good things. And so please get onto my mailing list if you would ever have an interest in that. Also, TradersHelpingTraders.com, you can go to my section, because we are building that out, and I'm including other people that can offer a wonderful information for us. But in my section, which is the main section, you can go and look back at all of my video podcasts and some of my writing, and you can see more about who I am and also get information on the trade room. Again, the trade room, my focus is going to be on education. I want to personalize everybody's education process because I feel that it's so important that all of us that really have a zeal to come in and do this, and we want to be successful, and we see the moves, and we see other people making big money, it's all possible, folks. But sometimes we just need that little bit of additional help, and that's what I want to offer. I want to offer a simple approach to trading, not making it all this complex, but just a very easy to follow, easy to kind of really wrap yourself around and not necessarily master, but become good at. And so once we combine Elliott, Fibonacci, and the moving averages, I have found that I stay out of trouble and that I'm able to be more consistently profitable. And when I add that last component about not being my own worst critic or my own worst nightmare, but sticking to the plan. And so, Steve, I agree with you on what you said. Not shorting unless he's above the point of control and opposite on longs. So I agree. I have to, thank you. I have to end it there because I need to turn this back over to David. Thank you very, very much for the invite. And thank you everybody else for coming in today. Thank you.